Hello, everyone. This is Alan from TheIntuitiveTrader, and I was just having dinner with a couple of guys from Silphus Trading. They do commodities, and I was a founding member, and then we sold it, so I'm no longer associated. But we had an amazing conversation. And, they sort of suggested, why don't we just have a sort of podcast, and we're able to talk about what's happening in the market and touch a few topics. And I thought that was interesting, but I thought we should maybe, see what it would be like if we threw a video out. And then I thought, well, I'm alone here right now and all of these topics are in my head. Let's just, create a video. And, let's just get into it now, right? So, just as a basis, we were looking at Bridgewater and their economic report and what Bob Prince was saying. He's the co-CIO of Bridgewater. And I thought it was very enlightening, and I wanted to reiterate some of the topics discussed there. So the market is still closed. I have a cup of tea next to me, and I think we can just jump into it, right? So, just to start off, I think it's important to note that we have obviously transitioned into a new monetary policy regime, right? And so the nature of this cycle is radically different. And even without it, we would be in a different kind of monetary and business cycle regime. But, importantly, the virus has taken root, the coronavirus, and it has become a variable attached to almost any topic that we discuss. So just to focus on where we are now and how that monetary policy cycle fits in, there are really three key elements in current circumstances that I think we should be talking about. And so the first thing would be we have a collapse in global income caused by a global pandemic with interest rates at zero. Now, if you take a step back and you look at it, this is very different than a typical economic cycle, because a typical economic cycle is a contraction in credit brought about by a tightening of monetary or fiscal policy, which is largely under the control of the central bank. And when things get bad enough, they cut interest rates and ease monetary policy, and we come right back out of it with an expansion of credit. So what's happening now is that we are in a collapse of income, and that the causal influence is the coronavirus and the fear of safety for most people, right? I think we can all relate to that. And people are staying home and not producing things. So we've experienced sort of a short-term collapse in income, and a collapse in income causes a collapse in spending. So whereas normally monetary policy leads the tightening and credit falling and then spending falling and then income being the last thing to fall, income has now been the first thing to fall. So we see a reduction in spending and a number of reactions to that. So the driving influence is the virus, which no one really understands well, minus maybe a few agencies working on it, but let alone the government and the response to the virus and the response of the public to the government. These responses vary quite a bit globally, right? So from the US to Switzerland and France, and all of those have been very varied. So we have a big amount of uncertainty there. And to pull out of this, you have zero interest rates. We're also going in to this accumulation of credit as opposed to reducing credit. So normally in an economic contraction, we're reducing credit and raising interest rates, which gives us a lot of room to cut interest rates to expand credit coming out of it. In this case, we have zero interest rates. You can't cut them, and credit is expanding, which reduces the chance to pull out of it. So the solution to that problem, right, is something that Bridgewater terms monetary policy 3. So monetary policy 1 is really just interest rate monetary policy, which comes to an end at zero, right? So that doesn't really matter right now. But monetary policy 2 was the QE-driven monetary policy post-2008, where we just buy the assets. But when the risk premiums are already low, there's a lot less potential for that. Monetary policy 3 is the coordination of fiscal policy with monetary policy, where really the biggest actor is the fiscal stimulation, where you can direct the funds to the parts of the economy that most need it. But that needs to be supported with monetary policy and the printing of money so you can go buy those bonds and the interest rates don't go up and reverse the effects of what you were trying to achieve. So ultimately, that is a direct reflection of the fact that we're at zero interest rates, income and income levels are depressed, and the actions today are roughly appropriate. So, In other words, the amount of printing and physical stimulation has been roughly sufficient to fill the hole in income that was created. But not all of that money is being spent. So, let's say that 50 cents to the dollar that the government is spending is being spent. Right? So there isn't that much improvement in the economy. But compared to the liquidity in the system, it actually looks quite good. The liquidity looks good because there's all this cash being printed. In addition, the central bank is, just printing money over and above what it would take to finance those deficits and sending that into all kinds of assets. And so we have a major inflation going on, which has been by and large so far successful. The big question about this is that while we're used to thinking in terms of growth rates, which is changes in output over short periods of time, the big thing that is happening now to be thinking about is really the collapse of income and the level of income that exists. Because the low level of income that exists will be with us for a while in a substantial way, which means lower profits, lower spending, and so forth. And so you've seen with certain companies like Microsoft and Nvidia, these lower priced products being released. And so that means lower cash flow. And so for those that are sort of on thin ice already, the longer that this goes on, the more difficult it is, or the more difficult it will become for them, right? So we have two pressures operating at the same time. Collapse of income, which collapses cash flows, which affects people who are vulnerable to a collapse in cash flow. And then we have an expansion of liquidity for the central banks going into assets, but potentially not sufficient enough to cover those cash flows. And those programs today are by and large sufficient to cover the income gap, for around, let's just say 3 to 4 months, starting back in April. So the amount of money can get you through a summer. And the problem then is that we're talking about the virus, which is a time frame of about 2 years, which means we've arrived at what, Bob Prince would term a duration mismatch. So ultimately, the markets are rising because they're focusing on the liquidity side of the equation and not the cash flows. And so what does that mean for traders? And what should we be looking at? And what is clear here and what isn't clear here?